All right, so here we got federal income tax. So there are things called tax credits, which are sums of money that reduce the income tax owed by the full dollar for dollar amount of the credits. And so sometimes we can take those. There's also things called withholdings, and employers deduct federal taxes based on a percentage of your gross pay. So when you're looking at your pay stub, the withholdings are how much they took out for federal taxes. Now, if you're self-employed, you have to pay quarterly estimated taxes. And so you basically pay your own taxes every quarter. And then at the end of the year, you hope you kind of got your taxes correct, and then you don't have to pay any more at the very, very end. And then a tax refund is when a taxpayer made more payments than they owed, and so they get a refund. Now, if you don't get a tax refund, that means you owe money at the very end of the year, and so you have to pay extra. All right, so calculating federal income tax. So we're going to round all numbers to the nearest dollar. So basically, we're going to determine your adjusted gross income first. And again, we've talked about that. Your adjusted gross income is just your gross income minus adjustments. So basically, including payments to tax deferred savings plans, a percentage of college expenses, etc. And your gross income was all the stuff you made throughout the year for wages, tips, investments, your interest on accounts, things like that. So that's going to be your gross income minus your adjustments to get your adjusted gross income. Now, to determine your taxable income, then you subtract off the deductions. So we talked about that. And again, the key piece here is the medical expenses exceeding 7.5% of your adjusted gross income. So if you have medical expenses, once you find your adjusted gross income, you have to take 7.5% of that. And if that number is greater than that 7.5% of the adjusted, then you could take it off. If not, then you can't take it off. So then you can only take off your charitable contributions, property taxes, state income tax, interest on your mortgage, things like that. So those are really key items to think about when you're working on these. And then determine your income tax. Basically, you take your tax table, you compute that minus any tax credits that you have, and then that's going to be your income tax. So this is an example of a tax rate for 2021. And again, it's split up. We have unmarried, divorced, or legally separated. Married, each partner files a separate return. Married and both partners file a single tax return, or unmarried and paying more than half the cost of supporting a child or parent. And then you have your tax rates, how much you have to pay. Here's your standard deductions. So note that you pay 10% on up to that amount. Then you pay 12% from that amount to that amount, and then you pay 22% on that amount to that amount. And so depending on where you are, you're going to have to take each of these numbers times however much is in each basically column, and then that'll get you your final tax amount you have to do when you add them all together. So let's look at an example here. So it says use this form here and calculate the federal tax owed by the person with the following. So what do we know? Well, we see that they're single and they are given the following. So we have our gross income, we have adjustments, deductions, and the tax credit. So let's first find the adjusted gross income. So adjusted gross income. And that's going to be, well, that's going to be your gross income, the 45,000 minus any adjustments, which is only $4,500. So plugging that in our calculator, we should get $40,500. Okay, so that's our adjusted gross income. Now we have to kind of do like we did before. We have to think about itemized values. So the deductions are going to be these. So if we take and add all those together, we get 3, 4, 5, 8, 5, 0. So the itemized deductions is equal to 5,850. Now, because they're single, what is the standard? Well, the standard is 12,550. So the standard deductions is 12,550. Okay. So which one's bigger? Well, in this case, this one is bigger. So we'll want to subtract off that for our deductions. So that's our next step, and that's to find the taxable income. And that's going to be our 40,500 minus the 12,550. And that gives us a taxable income of $27,950. All right, so that's how much we have to pay. Now, where does that put us? Again, we're in the single column, and so that puts us into this area right here. So that 27,000 is going to be kind of somewhere in the middle here. And so that means we have to pay so much at 10% and so much at 12%. So that means we're going to take 0.1 times that number it said was 10%, which was 9,950 plus, and then we had 12%, and then we're going to take our 27,950 minus our 9,950. And when we plug all of that into our calculator, that will give us how much we owe. So let's go ahead and see if we got our calculator working here. So now we're going to take zero point 0.1 times 9,950, and then we're going to add to that 0.12 times, and then we had the 27,950, and that was minus 9,950, and that should give us how much owe in tax. So 3,155. So that's going to be 3,155. Now, no tax credits, so we can't subtract anything off. So that then is going to be what we owe for taxes. Okay. And that's how we would get the value there. And again, all these can change depending on the problem. They might have had a tax credit. You could have subtracted off $500 or something. Or, these values up here would be different. You might have had one with a medical expense, and then you had to determine if it was at least greater than 7.5% of your adjusted gross income. And so there's a lot of different ways we can play around with these numbers, but this is one example. All right, so let's stop there and come back for more.